Good afternoon, everyone. This is Bill Lipinski. I believe we have just about everybody on that's going to join us. I'd like to welcome you all to our Customer Service Council webinar. We have almost all 19 offices and the Customer Service Council members on the call. I know we have some director candidates that have joined us. Certain nominating committee members and staff and guests and directors either from home or join us from our council meeting. So I would just like to welcome everybody to our meeting. Today on our webinar, I'm going to give you an update on Farm Credit East financial results for year end, some comments on what's happening in the farm credit system nationally, maybe a little bit about our thoughts going forward into 2013, and then take any questions that folks might have this afternoon. So I think I'll get right to it. As I managed to goof up the slides already, we'll get going here. 2012 for the farm economy, we saw some slow recovery in the non-farm economy that's helped our customers. Some of those that are dependent on the housing-sensitive industries are starting to see relief as demand is growing, as housing starts have picked up. Certainly the inflation on the farm operating expense side has had an impact on how our customers will do for 2012. We're seeing that as we renew credits here at the beginning of the year. Grains and oilseed were impacted by the 2012 drought across the country, which has impacted prices. Certainly the weather we've experienced here in the Northeast has had a significant impact on customers. Probably the only good news from your perspective is we have a continuation of low interest rates, which has been helpful. And in general, there's a very strong outlook for agriculture in the U.S. and here in the Northeast. Relative to Farm Credit East, our loan growth is starting to pick up. As you can see on the slides there, we've increased loan volume close to $340 million over 2011, and really after a couple of years of stagnant growth as people were making adjustments to their operations, we're seeing that carry into 2013. A bright spot for us is the continuation of financial services growth, up by over $2 million as customers are utilizing our services to help them be more successful in their farm businesses as we go forward. Our loan portfolio is improving. After a couple years of deterioration, we're starting to see overall loan quality improve across all segments. A little bit ironic, though, our high-risk assets are continuing to have some deterioration. High-risk assets are, as you've all heard me talk about in the past, are assets that we don't accrue interest on. They're credits that are really experiencing difficult times. They're either in bankruptcy, foreclosure, or their loans are over 90 days delinquent. We've had a number of credits since 2008 that have kind of hovered between being okay and not being okay, kind of on the razor blade of life. And this past year, we've seen a number of those kind of shift into the high-risk asset category and are on their way to some resolution. So it's a bit ironic. At the same time we're experiencing an improvement in credit quality, those accounts that are having some difficulties are really kind of moving through the high-risk asset arena. While those high-risk assets have increased, we continue to set aside loan reserves to cover any potential losses that we would have on those accounts. We've had a long history of not really experiencing significant losses, but as agriculture is shifting, the economy is deteriorating, and real estate values have either been stagnant or decreasing, we're starting to see a few losses appear. And so we've improved our allowance position to be ready to withstand any kind of charge-off activity that we might have. At the same time, we continue to improve the capital position of our organization. What you see up there is a slide of capital and risk funds. That's our capital and allowance added together. That continues to increase as we want to be in a position to help customers withstand business cycles. At the same time, we've maintained our efficiency of operations. We pay close attention to being a very cost-effective organization. We simply rent money from the capital markets to you. We want to do that in an efficient way, so the board and the management team continues to focus on providing customer value through being a very efficient operation. Net income, as you can imagine, then continues to be steady. We set another record for earnings as an organization. Again, as you've heard me mention in the past, maintaining strong net income is very important to assure investors that we have a source of repayment on our bonds and notes that we raise capital with through the Funding Corp in New York City. Then after we've demonstrated the earnings that our organization can generate, what we don't need for reserves, capital accumulation, we return to our customers in the form of patronage. The next chart really just shows the track record of patronage that we have done over the last 17 years. This represents kind of the annual patronage dividend declared by the board. If you move on to the next slide, on top of that, then, as it wasn't the case in earlier years, we retained a certain portion of those patronage dividends for allocated equities, and we revolved those out over a 5-year period. We redeemed all our allocated equities that were left in the organization in 2012, kind of way in advance of our original plan. So in 2012, customers basically got twice the amount of patronage they normally get, and that's really due to the efficiencies and capital growth we've achieved through our last merger, and a sign of real good success. Going forward, we plan now not to retain any allocated equities and pay all our patronage in cash, which amounts to just about 100 basis points or close to 1%. And in this low rate environment, that's a pretty good value. One of the things that also helps us here at Farm Credit East, aside from geographical diversity, is loan diversity. We lend to just about every kind of agriculture you can imagine across the Northeast. Dairy still represents a significant part of our portfolio, but it's diluted by interest in a lot of other businesses. You guys can see that on the chart that's in front of you, just a variety of agricultural operations that we fund. Kind of turning the page away from Farm Credit East for a moment, I just want to talk about the Farm Credit System. I always preface this by saying it's very important that as an organization we pay attention to how the Farm Credit System is doing and are active in national affairs. We basically co-sign each other's debt to ensure investors that we have a strong system capable of meeting our commitments to our bondholders and note holders. And so we monitor the health of the system. And I'm pleased to report that in general, the Farm Credit System across the United States is doing very well. Loan volume increased over 9%, close to 10%. We have about $192 billion of loan volume in the Farm Credit System across the United States. Net income was up to $4.1 billion. Total capital is $38.6 billion, close to $40 billion. And relative to leverage, we have about 16% capital to total assets. We spend a lot of our activities advocating for farm credit and our customers. So we're active in Washington activities. Primarily the last couple of years we've been involved in farm bill deliberations, especially as it relates to supporting risk management initiatives and insurance tools, which we think provide a safety net to many of our customers. We've been one of the leading associations, frankly, one of the leading organizations in trying to work for farm guest worker reform. We've developed through our activities in Washington, led by Bob Smith, a strong working relationship with members on the Ag Committee. Here in the Northeast, this past year, we've really added a number of committee members to both the Senate Ag Committee and the House Ag Committee, which gives us a chance to have influence to some degree as we work with these folks to make them understand the value of agriculture to rural communities and the value farm credit brings to those folks. We also, you've heard me speak in the past about what's happening with the other government-sponsored enterprises. We're part of what they call the GESE world. Fannie Mae, Freddie Mac, Farmer Mac, and the Farm Credit System are all set up for a public policy purpose to help meet what were perceived deficiencies in the marketplace. And as you all know, that Fannie and Freddie went through some significant challenges, were in essence taken over by the government, and are trying to figure out what their path to the future is going to be. And as Congress mulls over those challenges, we want to make sure that we don't get sucked into any new things that would limit the value we provide to agriculture across the United States. So we monitor that very, very closely. One of the things I'm very proud of in Farm Credit East is how active our staff is in the local communities they serve, and how valuable agriculture is to the infrastructure of the Northeast. So we've spent a lot of time in the past few years trying to educate the non-farm public to the value agriculture brings to the Northeast, and also be able to utilize it in the kind of work we do in discussions with policymakers at the state level and in Washington. So we commissioned a study done by a professor at UConn and edited by our team to create an understanding of the economic value agriculture brings to the community. If you add up the 6 states that we work in, it's about $71 billion of economic activity and about 380,000 jobs on and off the farm. Really a significant impact to the economies here in the Northeast. Coming back to Farm Credit East, I thought maybe I would just share with you what our priorities are for 2013. Some of you just got through the customer survey that we do every so often. It was completed in 2012, and it gave us good information about what's going on in the marketplace. We see that competitors are starting to be interested in Northeast agriculture again. So in addition to continuing to be a valuable partner, as we have been for the last 100 years or so, we're focusing a lot of energy and effort on customer retention this next year. Serving customers and meeting their needs is going to be our first priority. We want to also stop focusing so much on what's going on inside of Farm Credit East and try to focus more on the marketplace and grow loan volume and our financial services that we provide to our customers. We're increasing our activities as it relates to outreach and working with kind of non-traditional farmers. The local foods movement certainly brought in a lot of new entrants to agriculture, local foods activities, and urban agriculture. We also are trying to improve the teamwork between all our staff as it relates to the customer relationship and the services we provide. As you've heard me talk about the financial position of the organization, another key priority is to continue to maintain the capacity that we have here at Farm Credit East to be able to meet future credit issues, credit needs as our customers, as agriculture evolves. We believe our team are leaders in the Northeast Ag community, and we're going to continue to do that. At the same time, as we try to initiate new activities, we want to maintain our efficiency and value proposition. A big part of that is through the utilization of technology with our customers and with our staff to be more efficient. And we think the combination of all those activities will drive value to our customers through service, pricing, and patronage dividends. I hope all of you are proud of the financial results that we continue to generate based on good customers that are meeting their obligations, and I think that's something that we'll continue to be able to do. We are very optimistic about what's happening in agriculture. There continues to be a growing demand for locally grown foods, specialty foods, high-end farm products in the U.S., but I think that bodes particularly well for our customers here in the Northeast. Of course, the New York Greek yogurt boom has received a lot of attention and created a demand for milk products. We observe that as agriculture across the U.S., the strong grain and oilseed markets helps keep customers from moving into dairy, nursery, and other activities that might be competitive with customers in our area. So we think that's good. The growing export markets are generating demand for food products. There seems to be an awareness and commitment to help deal with hunger, which again will help boost exports. We're pretty confident about what's going on here in the Northeast and our competitive advantage of our customers. Many of them have proven business skills. They're able to operate in a very unique environment. They're very adaptable and resilient. The resiliency to adversity is just absolutely tremendous. We're seeing our customers really lead the U.S. in terms of awareness of risk management, taking advantage of all the tools that are available to help mitigate risk. As you saw in the director video, we have really a promising group of farmers in the next generation to help lead agriculture and be a part of larger farming operations. And as I work with young people and spend time either interviewing and recruiting, just kind of an unprecedented interest in the agriculture and agricultural careers. So with that, I'll end the conference. I think probably you have an opportunity to text chat in questions. Bob Smith is here shaking his head, and so I'll try to respond to anything that you have out there. Anything's fair game.
Thank you, Bill. We do have a couple questions in, and again, please text chat your questions in. First one comes out of the Greenwich office, Bill. Do you see global fallout as a result of the action that Cyprus took to put place the 10% tax on deposits, or proposed to take?
Boy, I'm telling you, we're going to have to start getting dumber customer service council members when they start asking me those global finance questions. Yeah, I'm a little concerned about that. I mean, as most of you know, I'm not a big tax guy in terms of generating public revenues to support spending habits. So certainly what the path that happened in Cyprus, I don't think is a great solution to a troubled economy. And so I am very concerned about how people will react to that as a solution.
Next question comes from Middleborough. What drove the loan volume in the farm credit system this past year?
You know, one of the things that's I probably failed to say, in Farm Credit East, because we have over a 70% market share, our ability to grow our loan volume is dependent on our customers making investment in their farm operations and then picking up a few new customers here and there. But there just really isn't that many new customers that we can go out and recruit and try to compete for. That's contrary to what's happening across the rest of the United States in farm credit. Historically, the farm credit entities in the United States, in general, not all of them, have owned the long-term market. That's where their market share is high. They've had the long-term mortgages, and the commercial banks, because agriculture has been their primary place to lend in rural communities across the U.S., have been very interested in ag. I think as they were distracted by financial difficulties coming out of 2008, it's given Farm Credit in general an opportunity to pick up market share, particularly on the short-term side. So there's two things happening across the United States. The Farm Credit system is picking up market share as it both has improved operationally our businesses across the United States, and then, of course, the land appreciation and the land transactions that are going on as agriculture continues to thrive has given them a chance to have more long-term volume on the real estate side. Now, of course, that gets everybody nervous in the service, so to speak, is are we lending in the United States Farm Credit System on inflated values of agricultural land? And I do get a chance to travel nationally and serve on different national committees, and I know the underwriting in general has been very, very conservative. In a lot of cases, farms that are being bought are add-on units, and that's giving customers a chance to put those in with their existing farm mortgage. And so from Farm Credit's position, I think they're pretty safe loans. So generally, it's picking up market share and appreciation of assets and turnover of real estate.
Well, the questions are really coming in good, and we appreciate that. One coming in from Batavia. High-risk assets increased. Is this driven by one sector or size of loans?
Both, to some degree. We've had a couple larger customers that we've been working with for an extended period of time. Particularly, I would just focus it in the green and nursery side of the business, or businesses that are dependent on the non-farm economy, that have been reluctant to liquidate real estate assets at lower values. I mean, they might have, 5 years ago, the farm might have been worth $1 million, and it's probably worth $800,000 now. And historically, in the Northeast, customers have been able to get out of either management missteps or problems with prices or some adverse thing that impacted them through liquidating non-essential real estate. Well, that's getting harder for customers to do in this economy in a timely way. And so we've had a number of customers that are a little bit larger that have been reluctant to liquidate real estate to get out of trouble or liquidate assets. So we've kind of lost a little patience with some of those folks and have been accelerating our actions. We need to do that to create space for other customers that might experience difficulties in the future. Our historical strategy has been to be very patient and give customers the chance to make their own decisions and have a strong capital position as an organization so that we can give customers the chance to have time and be patient. But at some point in time, your patience runs out and you have to kind of accelerate activities.
Bill, we got a couple questions Middletown came in with relative to farm labor. What is Farm Credit's position on a pathway to citizenship?
I don't know that we have I know we don't have an official position on pathway to citizenship. That's not something that we have talked about at the board level, and that's certainly not something that I'm going to get involved with in a discussion on as a CEO of the company. What we have taken a position on is that there needs to be a workable farm guest program, and we've been advocating that for a number of years, and we continue to work very hard, and that's where our primary focus is on immigration reform, is that there has to be a workable farm guest worker program.
Very good. And that really, I think, deals with the second question as far as H-2A. No particular H-2A change is pending right now. The proposal in Congress for agriculture would develop a new guest worker program, not reform H-2A per se. So it would have two guest worker programs, at least for a while at that point. Question came in from Enfield. Do you know anything about the potential for tax law changes eliminating the accelerated depreciation rules that currently exist?
Yeah, I mean, certainly that's at risk. I mean, it was maintained through the fiscal cliff legislation that accelerated depreciation could continue because, I mean, that certainly encourages investment and the purchasing of assets. And as our government looks for ways to enhance revenue through tax law changes, I would say that's always on the table. And you know, policymakers have got to evaluate whether accelerated depreciation or old tax incentives like you know, investment tax credit are ways to help spur the economy. But right now there seems not to be as thoughtful consideration about how tax policy could drive investment as much as there is as how tax policy could help reduce the deficit or generate revenue.
I'm going to two more questions, and then we're going to close off. Regarding risk management, do you see stricter criteria to obtain crop insurance after the last 2 years of natural disasters?
Yeah, I mean, I think one of the challenges for the farm advocacy groups is that Congress in general bought into the idea of crop insurance as a way to support agriculture. But due to the unprecedented weather activities and drought, there's going to be record payout of crop insurance funds, which is going to impact the agricultural budget area and impact appropriations. So I certainly think as Congress evaluates ways to reduce farm bill spending and other fiscal spending by the government, they're going to take a harder look at how crop insurance is administered. They've already started that by really cutting back the commissions and the earnings that those of us that are involved in offering crop insurance can get. I mean, the underwriting for the most part is handled by the government, but those of us that are involved in administering the program have already experienced a significant cutback in commissions and earnings that we can make offering the services.
And a final question, Bill, and then we're going to go on to Dr. Scherr, but are we going to have to live with the notion that some banks are too big to fail and all that it implies referring to government bailouts?
I think we're going to have to live with the notion that there's some banks that are too big to fail while we unwind this, because none of the legislation that has taken place over the past few years has really done much about the consolidation in the financial services industry. What we can hope for, and you know, the Farm Credit System could be a model for this in the future, is that the regulators are a lot tougher about building capital in those institutions such that they could withstand shocks. And I'm not so sure that, you know, all the stress testing they're doing is going to work, because you know, stress tests are usually based on what happened in the past, and anything that's been a big event that caused a shock like what we saw is usually unprecedented and hasn't been predicted. So I think, yeah, I think for a while we're going to have to live with it as some of these banks return to stronger financial position.
Thank you, Bill. Great questions out there. If I did miss some branch managers, please let me know that, and we'll get back. But I think we covered them all. Really appreciate your input to that. We're going to move on to the second part of our program now, the second part of our webinar program now. We're real pleased today to have Dr. Bruce Scherr, Chairman of the Board and CEO of Informa Economics with us today. Informa, that's formerly Sparks Company that some of you may recognize. Dr. Scherr is the former president of Sparks, Jacobs, and Scherr, and president of Agri-Commodities, an agriculture consulting firm based in Andover, Massachusetts. He received his bachelor's degree from Rutgers University, so he has a Northeast background there, and his MS and PhD from Purdue University in agricultural economics. He serves on a number of boards, including FFA Sponsors Board, and has served in the President's Council of Economic Advisors. Without anything further, we're very pleased to introduce Dr. Bruce Scherr. Bruce?
Good afternoon, and thank you. I'd like to express appreciation to you, Bob Smith, and Chris Lawton for organizing for me to be able to join you today. And my discussion is pretty much along the lines of a presentation I made back in September that I think Bob attended at the Farm Credit National Directors Conference. But I've added a couple things. The title is pretty long-term as we look at opportunities for agriculture and food and the whole value chain moving into the next couple of decades. And so to set the tone, let me kind of give you the punchline at the beginning and then fill it in. I am exceedingly optimistic about the United States economy and U.S. ag and food if we will just do a few things right. I'm not unrealistic. I realize that this optimism could be dashed by such things as stupid policy. Our Congress has been the poster children for that lately. Institutional failure, not unlike subprime lending and other fraudulent reporting and the like. Certainly pandemics and wars are all things that can upset what I think is a very optimistic outlook for both our economy and the ag food sector. I didn't include any information and any charts here regarding the macroeconomic outlook for the U.S., but as we get to the Q&A, if anyone has an interest there, I'm happy to provide a quick overview of the macro outlook, GDP components, with a particular emphasis on the national housing outlook, which I think is one of the key ingredients to expansion as we move in the next couple of years. Having said that, what I'm going to do is I'm going to set a long-term view first by discussing the engine of all engines in a global economy, and that's global demographics. And I'm going to do that in a couple of different ways, both in terms of the push and the pull, and there's general agreement on large numbers of people populating the earth over the next several decades, but it's not without some issues. Secondly, I want to talk about the role of global infrastructure, particularly in the emerged economies, and what this has meant to commodities as an asset class. Then something I'm putting in that Bob wasn't at that meeting we had before, and that is moving from 2012's devastating drought with a focus on corn and soybeans, which are at the heart of this. To put this in some perspective for you, the agriculture food value chain, which to my mind in the U.S. is one of the most modern and extraordinary capacities in the world, has operated over quite a few months now since the lack or a reduced 2012 harvest, with about 5 to 6 billion bushels less grain than it had anticipated. Now that means there's less grain to elevate, there's less grain to move around, there's less grain to export. What we didn't export, we've held back to meet domestic needs. And we've had forward curves for corn and soybeans. Corn reached $7 a bushel to $8 in July of last year, and it's stayed there to this day. With little volatility, beans, got to $14, $15 to $16+ and it stayed there from July through today with little volatility in that narrow range. But everybody who uses those commodities has been paying up, and it has had a dramatic impact on ethanol production. It's had a dramatic impact on livestock feeding, less than we had anticipated, but an impact nonetheless. And so when you underutilize your capacity, by 20 to 30%. And you've got a corn belt that's set as a tale of two cities, reasonably great condition in the eastern corn belt, and a bullseye in the western corn belt that continues dry, with the prospect in mind that you could still produce a heck of a crop as long as we go with reasonable topsoil moisture through the year. But concern, it's like holding back reserves. To my mind, dealing with every part of the value chain, everyone's become very tentative. It's like maintaining reserves against a future problem. And until the entire ag sector sees a realization that it can have a high probability for corn yields that might be near trend and bean yields that might be near trend, this is a very nervous subsector of the U.S. economy, and rightly so. Now, having said that, you know, as I leap from the demographics that we'll talk about and the infrastructure discussion, I want to focus on what I consider to be the productivity challenge of the future. That's not to diminish the leap from last year's devastating drought, because the question for the U.S. is how permanent is the demand damage? Do we lose share around the world, or is there enough broad-based opportunity? I think there probably is, even with short-term glitches. And then I want to talk a little bit about energy as a game changer that was really not on anybody's radar screen 10, 15, 20 years ago. I mean, testimony is during the Bush administration, we had legislation to produce 36 billion gallons of renewable fuels to supplement 160 billion gallons of gasoline consumption. Well, we're consuming 30 billion gallons less gasoline, and we are nowhere near 36 billion gallons of economic renewable fuels. But gas prices aside, that energy environment not so long ago is radically different today as we look at the role of natural gas. So having set the stage, let's move forward, and let's start in with the demographics. To begin with, you know, as of November 1, 7 billion people on the face of the earth. Well, as we keep going on over the next 2, 3, 4 decades, we're going to be feeding 7 to 9 billion people. That's a heck of a jump. And so there's a demographic pull. But as I want to show you here, there are two features that we want to focus on. One is the graying of the population around the globe, particularly in the industrial economies of the world. And as we look at the infrastructure developments that have changed the whole role of commodities as an asset class, including agriculture commodities, I'll elaborate a bit more on constraints as we follow the development of the cold chain. Literally, not rocket science, but the use of refrigeration from farm to consumer and all parts in between in the value chain, which radically alter the way in which agriculture commodities and food are produced, distributed, and utilized. Well, let's start first with the population. And I'm using some charts that were put together by the Center for Strategic International Studies. And this is work done by a fellow named Richard Jackson, who actually spoke at our Fall Outlook Conference, and so I borrowed a few. The red bars are pretty straightforward. You know, that's getting to 9+ billion people by 2050. And you can see, though, that that's achieved at a rather dramatically declining population growth rate. Well, how does that happen? Well, what happens is the population around the globe ages, and that's because, and nobody's going to complain about this, particularly in the industrial world, but all over the globe, because of medical advances and the ability to transfer technology on a much more rapid basis, people will get older. In the industrial economies, people will age to, you know, they're already aging to 80 or so, lesser in the emerged economies, but they'll start to catch up too over the next several decades, and that's a credit to medicine and more management of disease than curing them. But that's also because in the industrial world and parts of the emerged world, fertility rates are dropping off precipitously. We'll talk about that a little more. But you can see, essentially, all over the globe, industrial or emerged, the economies, the nations around the globe will all have larger proportions of older people relative to younger. And that's an interesting implication because, you know, that means there are fewer young supporting retirement programs. Traditionally, while older people have good institutional knowledge, their productivity declines. The elderly are not generally good gun toters. And there are a bunch of other features to that effect. And so if one measures GDP on a global basis as people times productivity, you've got lots of more people, but maybe a challenge to productivity and a challenge to growth. Here's the fertility rates. There's interesting things in here. You can see that with the exception of the U.S. and France, you need 2.1 children per female to replace a population. You can see that in the industrial world, other than the U.S. and France, nobody's even close. As a consequence, this sets up an inability to replace the population. As people get older, the aging and graying of the population, and it sets up some very interesting immigration questions and immigration rules, because the basic fuel, that's people, of an economy start to decline. So a couple interesting ones here in the emerged world. One is China. You'll notice a declining fertility rate down to 1.6. They've got an even more peculiar element there because of Chinese focus on male offspring and literal infanticide for decades of young female babies. That population, and this has never happened ever before, has an inordinate number of males relative to females. I've made the joke that goes back to the old movie of Seven Brides for Seven Brothers, where maybe we're talking about 400 million brides for 400 million brothers here. This is both socially and nationally, I think, quite a difficult and challenging feature, aside from the me generation of single children families and the attitude of that. From a regeneration standpoint and from a social standpoint, that's pretty critical. The other big one on here that you should be aware of is Russia, the lowest, one of the lowest numbers on the chart. And that's because 1 out of every 4 Russian children is born with some kind of significant health defect, predicated on bad health habits by the parents, particularly alcoholism, and very, very poor prenatal care. Russia is the only major nation in the world that will have a declining population over the next several decades. Raises geopolitical and social issues there too that one might think about. Here's the life expectancy numbers. You can kind of match them up. You can see the industrial world better than the emerged world, but the emerged world catching up. Just to give you a little home focus, when Social Security was designed, the average longevity was 64 years old, and benefits kicked in at 63 years old. Benefits kicked in at 65 was an equation for solvency. Well, if benefits kick in at 65, 66, and people live to be 80, not such a well-balanced equation. Just to summarize here, you can see that between today and in the year 2050, the big players change. But look at us. We're up near the top. Therein lies one of my great optimistic views of the U.S. We will not only have the productivity, but we'll have the people. And when you put the two together, we, as the $15 trillion economy today, the Eurozone is the next size, 11 trillion. China is 7 trillion. That smacks of a reassumption of economic and global leadership, as long as we don't foul it up with institutional failure. And you can get a sense for the other countries that will be growing. Now, we'll keep this list in the back of your mind, because as we talk about infrastructure development, and the cold chain. We'll go back to that. I'm going to skip here quickly and go to this chart. This is a chart that shows how the value chain for food evolves. And clearly, as people become wealthier, the horizontal part of the chart, they consume more value-added food. And when I talk about the cold chain, I mean, if you look at, as the green arrows push out, the key here is, why do you have wet markets in places like China? Because the only way to keep the food preserved, the chicken, for example, is to keep it alive and feed it. When the day it's going to be consumed, you slaughter it because there's no place to keep the animal preserved. Well, if you look at a country like China, which is the quintessential example, wet markets are disappearing because the cold chain is being put in place. There's refrigeration at farms, refrigeration at, well, take dairy. Dairy, Chinese were viewed as lactose intolerant for many decades. The most rapidly growing segment of China's food sector is dairy, because now the product can be refrigerated at the farm, at the distribution centers, all the way to the household. The evolution and development as people have moved from the hinterlands into urban and city dwelling is that stimulus programs in China are about putting things in place like refrigerators. It changes the whole nature of how the value chain works. It creates tremendous opportunity for the sale of imported meat and poultry product, and you can see a tremendous amount of interest there from pork producers and cattle association and the chicken folks as they are pushing product, American product, in that part of the world. I guess the other thing to say is, as you make those changes, you require infrastructure. The electric grid needs to be broader, wider, more robust. You need more electric generation. And so when I think about a country like China and the growing average income, and when you got a country of 1.4 billion people, if 200 or 300 million of them are earning at the $10,000, $15,000 to $25,000 per capita level. By the way, Kobe beef is the preferred product to be consumed at a Chinese wedding today. I mean, that means that of their 1.4 billion people, a population group the size of the U.S. is in very extraordinary income capability, and there are more to follow them. And so when you build the grid, when you build the generation, when you build the water systems, they're using things like copper, concrete. They're utilizing concrete in China at a rate of about 1.5 Los Angeleses per year over the last decade. I mean, this is, we're at the beginning of this change. We're not at the end. And it's not China alone. The sleepers here are India. Brazil is no sleeper, but it's formidable as hell. Indonesia, Argentina. I mean, it's going on all over the world. And with the U.S. as a source of an engine of economic expansion, sitting at the middle of this, it's really quite extraordinary. Now, I want to go back here and very quickly, here's a picture of the CRB index for commodities. It's all commodities for agriculture, energy, base metals, precious metals. What it says is that for decades, commodity values declined in nominal terms, that is unadjusted for inflation. All those green rectangles prior to the decade, last 10, 12 years just passed, every time we had a commodity spiral, it was about a supply glitch. It was a matter of supply, whether it was OPEC or a drought or something of that sort. And we spiraled prices, and we corrected them in 18 to 24 months. Price is a wonderful fertilizer, whether it's energy or agriculture, whatever the case. But over the long term, the values decline. That's uneconomic. An asset class should not and could not exist that way. It breeds inefficient use. Return on the investment to the asset class is uneconomic. The only reason we have that the seed industry invested in genetically modified seed back in the early 70s is because we were lucky. If they knew this chart forward up until the year 2000, I don't think they'd have voted in to spend those hundreds of millions of dollars on GMO development, because where would the return be? Now, the big daddy spiral of them all, which is the last 10, 12 years, that's the economic spiral. The anomaly was the decline in commodity values over the previous decades because of its non-economic, without return and inefficient use. And so my contention has been, and those of you that may have heard me over the last 10, 12 years, is that commodities as an asset class have appropriately achieved real inflation-adjusted value, and they will not turn back. They can't turn back as long as infrastructure, which is about steel, concrete, copper, energy, and by the way, you know what's a chicken? Corn, soybean meal, interest rates, and water, part of infrastructure. It all goes together, and so commodity values will not reverse back to where we were in the decades earlier. It's uneconomic. More importantly, what I think one has to realize is that while it took a couple of years to happen, over the last 10, 12 years, not only have commodities achieved this real value, but relative prices have adjusted. If you're going to have $7 corn, you're going to have $135 cattle. If you're going to have $7 corn, you're going to have appropriately priced ethanol, because the margins have to be achieved. Now, within this 10, 12 years, commodity values have expanded, but because of recession and slow post-recession rebound, what we've seen because of this is margin compression, because from the, we'll say the wholesale level to the consumer was, the supplier, the seller, didn't feel confident that they could pass those prices on. So while the underlying commodity values increased, the pass on to the consumer at levels of 2% or so were less robust when you've had this dramatic commodity increase. I believe as the U.S. economy and the global economy improves over the next 24 to 36 months, you will see an end to that, and there will be, albeit modest, pass-through of commodity value, and we'll see some expansion of consumer prices as we move into the next 24 to 36 months. Now, having said all that, let's move forward. And as I said, prices of motivator and a fertilizer. Here's a nearby corn price. Now, here's a distribution on corn. It's trimodal. You know, in today's value at 7 1/4, we got expensive corn. And quite frankly, you know, even as I'll show you here shortly, with a good new crop, you know, you're talking $4, $5, $6. At $4 to $5, $6, you're still talking, by historical standard, expensive corn. But by the last couple of years, you know, most farmers would tell you, hey, that, you know, you're really putting a dent in my value. Well, I think what we need to see as a value chain is ample supply and economic prices, more so than high prices and nothing to sell because of the inability to use the capacity that I talked about earlier, which is really quite a troublesome feature. You know, here's soybeans, and you know, with $14 plus soybeans today, you can see that once again we're looking at values that are out at the far end of the distribution. Let's talk a little bit about where we are today and moving from last year's drought. Here's a corn balance sheet. First thing I want to highlight is that 99 million acres that we took out of our last survey, we're going to come out Friday. And by the way, I don't know what our survey says until we release it. We keep it under a lockup, much like the USDA. But my guess is that 99 might be more like 97, 98, because of the relative value or return to corn per acre to beans today versus what it was back in January when we first did this. The key here is that 161 bushel per acre yield with a split situation between the east and the west corn belt. You know, there's a little work to get to that, but with topsoil moisture, we could even do better. I've had some farmers ask me, why don't you start with a 120 or a 140? Well, you know, a balance sheet is a snapshot analysis. With a good crop, we boost the carryout back to, I don't think it would be 2 billion bushels like we've got it here, because I think with lower prices, we would consume more. What you want to focus on here is that export line. Look at how devastatingly low our exports are. This gets back to my notion of an underutilized capacity. And I think that if we have a good crop, like we've indicated here, and we move back to something like $4 to $5 corn value, then those demand components are likely to be greater, and probably the carryout's below 2 billion, but it becomes far more adequate than where we were. The net effect is, you know, today's corn market is anticipating that we will have a good crop. You know, I can make a plausible argument with equal probability right at the moment for $4 to $5 corn and $10 to $12 corn. I don't know what the weather's going to do, and I'd be a jokester to sit here and try to tell you I do. But with that snapshot balance sheet, there's our expectations on corn. Beans, a little different story. If we lose the acres to corn, they'll go into beans, so maybe that's more like 79, well, maybe more like 80 million acres, with a near trend yield of about 44. Maybe that 250 carryout would be about right with lower prices. Certainly, you know, the balance sheet for beans would be less burdened than that for corn, as we've depicted it here. But with added new crop, you know, if you put another couple million acres, you're talking 100, 150 million more bushels. Bottom line is that the price expectations for corn, for beans, look a whole lot like that of corn. Again, it's snapshot. Tell me if that's going to be 43 or 8 or 39, and you got a really radically different picture for beans. So, I mean, again, I guess nothing is more important than the weather as we move forward into the next year. I would say we should all keep our fingers crossed, and I don't think it's too inappropriate to throw a prayer in or two that we have adequate weather, because we certainly, I think that is the better cure for our ag economy than even higher prices. Real quickly, grain consumption trends. Here's wheat. You know, over the last 7-8 years, we have added. Why do we need big crops? On a global basis, we've added 7 to 10 million metric tons each year over the last 7 years to consumption. As a consequence, over 7-8 years, you got 60, 70 million metric tons more wheat demanded around the globe. That goes back to my infrastructure. It's not just China, it's everywhere. And the world demands it. And wheat, which looks reasonably adequate today, is also potentially in tight supply. And we've seen countries like Russia lift import tariffs, Brazil lift restrictions to only import Mercosur grown wheat. And that tells you there is concern with the U.S. winter wheat crop in dormancy, with maybe better moisture today than it had a month or so ago pre-snow, but not great. We look at coarse grains. Now, this is exaggerated by ethanol, but if you normalize for ethanol, again, it's 7 or 10 million metric tons per year, 67 on a global basis. You put the ethanol in, and it averaged 20, 25. I mean, it was a big jump. It says you need a big corn crop every year, and that corn crop is got to be will be produced on a global basis. One of the things we've seen is a proliferation of production opportunities around the world. Price is a good motivator in fertilizer, and soybean, much the same picture. 6, 7 million metric tons per year growth over the last 7-8 years. Permanent demand. You know, Milton Friedman's old income hypothesis, you don't go back. You maybe have short-run changes because of price, but over the long term, you don't go back. And so if we look ahead 30 years, you know, the global demand pull for grains and oilseeds is extraordinary for meats and poultry too. You know, if we did we've done some work for the National Grains Council over the last couple of years. We boosted over the previous 30 years by 180 million metric tons for meat and poultry. Well, I think modestly it'll be 200 million over the next 30. If we look at dairy, we did 300 million in the previous 3 decades. Next 3, I think we'll do 500 million predicated on these bars. Vegetable oils, we did 100. We did 50. I think we'll do 100 million. Now that's got to come from someplace, and the U.S. is positioned as well as anybody to meet those needs. And so the productivity challenge is, can we meet it by land additions alone? And to the bottom line is, the world would need 250, 260 million new hectares by 2040. It's not there, folks. It's just not in the cards. So we better get it out of yields. Well, the problem is, let me go to this chart because we're running out of time here. If we go to yield improvement, while yields are still increasing at a positive rate, they're not growing nearly as rapidly as they did back in the 70s and 80s via the Green Revolution and the like. And so we are in need of investment both from the private sector as well as the public sector into further yield improvements that can be utilized not just domestically but around the globe in order to meet this extraordinary productivity challenge. Now, one place where the U.S. can achieve a tremendous competitive productivity advantage is via natural gas. And this is not really new. It's been operating. We've been seeing this divergence between crude and natural gas prices over 5-6 years, as exhibited in this chart, and this one as well. And then if we go to the differential, you can see the trend without the spike. I'm sorry, let me go back here. The question becomes, if the U.S. economy could go to near energy independence, and some are even saying independence via natural gas, because as we pull more nat gas, we pull more oil. We're using less oil from foreign sources because we'll have LNG and natural gas conversions across the country. In Connecticut, there's movements to support the households and businesses to convert from heating oil to natural gas. Now, as we do this, natural gas won't be that much cheaper relative to oil as it is, but consider if the U.S. becomes near energy independent and crude oil drops to $50, $60 a barrel, while that's a tremendous economic advantage to the U.S., households and businesses alike, lowering the cost of production, lowering the cost. It's just like telecommunications had. I mean, consider your telecommunications costs at home, long-distance calling versus what you do with a cell phone now or special. What you're not spending there, you're spending on other stuff. With energy, it's so pervasive, it's mind-boggling. But what are the intended and unintended consequences? While we may benefit there, what happens to the Middle East? Can the Arab Spring survive at $50, $60 crude? What will be the geopolitical and social implications of $50, $60 crude oil throughout the entire Middle East? Would the Middle East become more friendly or more foe? Are they going to be part of the disruptors or are they going to come to us for more aid and assistance? I don't know the answer to that question. All I know is that over the next decade, if we achieve near energy independence, it will trigger a geopolitical and social change in the Middle East that will become a dramatic challenge to the entire world. It will raise the question, the U.S. presence in the Middle East, which is usually predicated in words about being protective of Israel, to my mind has always been about being protective of American oil interests. What happens there? It does raise some big, big geopolitical questions. I think I've kind of run up against my time limit. I hope I've given you some ideas. Bob and Chris, I'm very happy to answer questions if we have time. And if anybody wishes, as I said, I'm happy to make comment on the macroeconomic outlook in as quickly as possible too. thanks very much for your attention.
Bruce, that's a great presentation. That's an unbelievable wealth of information here. We do have some questions, and I would encourage anybody else on to go ahead and text chat questions in for Dr. Scherr. First question, Bruce. Based on the commodity price chart that you had up there and your comments about the pressure on commodity prices in the next 18 to 24 months, does that imply a substantial pent-up risk of sharply higher consumer price inflation? If yes, well, what does that imply for federal policy and interest rates?
Yeah, good question. Good question. Actually, what I perceive is that we will see continued strong commodity values, but I think that the U.S. economy, if we could stop jumping from cliff to cliff, and that may be a big leap of faith, if we had rules to operate by, we don't even have to like them. If we just knew what the rules were, via, say, a Simpson-Bowles type program, I think that the U.S. economy is pent up with housing expansion, vehicle sales expansion, and what would be dramatically improved employment numbers because of housing going from, housing starts that dropped all the way to 500,000 in the midst of the recession, from 2 million pre-recession back to a mere 1 million housing units over the next 18 to 24 months. You're adding, 1 million jobs there. Unemployment migrates to under 7%. There becomes, we break out of what has been years of what I call the 2% economy, 2% GDP, 2% 10-year notes, 2% inflation, with greater growth this year of, say, 2.5% plus to 3% the next year. All of a sudden, inflation starts to not spiral at the consumer level, but expand. The Fed finally can say this U.S. economy has enough resilience that we can pop up short rates by 50 to 100 basis points. The yield curve would lift higher. Look, the yield curve in the last year, we started 2012 at 1.5% higher interest rates long-term than where we ended the year. And we're already seeing some modest migration in the yield curve higher for the longer rate. But we need governance that's in the public interest as opposed to personal political interest, and we need it right away. And that would change the nature of things. But under any circumstances, commodities are going to go their way, and unless the domestic economy can grow generally, margin compression would be the rule. If the economy can grow, business will have the opportunity to expand consumer prices, albeit modestly.
Very good. We have another question. This one comes from our Potsdam office up in northern New York. How will China's aging population impact China's imports and ability to produce their own food?
Well, China would like to be more, we've done a lot of work with the China National Grain and Oil Information Center and have done a series of multi-client studies on the livestock sector, the meat sector, corn and soybean value chains. They would like to be more livestock meat independent, which means their interest is to continue to import more grain and oilseed product, and have pretty much committed to the prospect of very large grain imports, that corn in particular could be 10, 15, 20 million metric tons per year, and continued growth in soybean and soybean meal imports, with greater crushing capacity expansion for job creation domestically. So I think that they have made a conscious choice to bolster their livestock sector and be more self-sufficient there than in grain and oilseed and related protein product, vegetable protein. And so I think that sets the stage for the next 10 to 20 years. And, their population is so big that even with the aging and so forth, we're just keep talking about population groupings that are the size of the U.S., and each group is tending to be from demand is made up of willingness and ability. The willingness is there. The ability to pay continues to expand.
Very good. I'm going to the last question, and then I'll ask you, Bruce, anything else that we kind of missed. But got a question that goes this way. You seem to come down pretty hard on Congress in your presentation. What's your opinion of President Obama's leadership, given the challenges that you're outlining?
Well, let me well, that's a good question, and the Congress is finally doing something that smacks of the way our government was designed. Ryan's bill has no chance of approval, but I give him credit for bringing it forward. Patty Murray's Senate bill has no chance of approval, but I give her credit for bringing it forward. It's now the responsibility of the administration to come up with a Simpson-Bowles-ish mid-ground that will allow for migration to a bill that can go into conference between the Senate and the House, so that people like Corker from the right side and people like Steny Hoyer from the left and others can come into conference and finally work out a bill. This is how it's supposed to work, that the public, as I said, may not like every part of it, but can live with and take as a foundation upon which businesses and households can make decisions. So I think there is a moment of opportunity for Obama to take the lead. I'm starting to see inklings of that, but not a definitive process from either both sides of Congress or Obama. But one of the reasons is they still have until like the end of April before the doo-doo really starts hitting the fan with respect to both continuing resolution, the sequester, $85 billion. We voted $60 billion for Sandy recovery. I'm not making a value judgment there, but I mean, we get this gigantic budget. So the question is, can we have one that works and that has a strategy as opposed to these continuing resolutions? And I think it's incumbent on the administration to set the center focal point and bring the two houses together into a conference so that we could get a bill that we could pass, and that by the end of April we might have some rules. And if we did, we've got pent-up liquidity, we have pent-up energy, we have a housing sector that wants to boom. We could take off, but we're in our own way.
Bruce, that's a great wrap-up in some respects, but I am going to turn it back to you for any final thoughts. We do have a couple other questions, but we're going to hold those. We will follow up with Dr. Scherr afterwards and try to get responses back to anybody that texted other questions in. We're kind of committed to close this off in the next couple minutes. But Bruce, any final thoughts, macro, ag-specific, that you think our audience ought to have as they think about their businesses, their farm businesses, over the next year?
Well, a couple points. Number one, a U.S. economy that has proper governance where we know the rules. You couple that with the most efficient, productive agriculture in the world. It just needs a little help. We've had 3 years of really stinky weather. It's never happened before. Every time we have a bad year, we bounce back. So with a little bit of divine help, this economy and the ag sector is poised to be the strongest in the world. Follow the cold chain, and follow the cold chain in those countries that I listed, and feel free to provide your colleagues these slides of those countries that are going to be the biggest and most robust by 2050. That's the vectors you want to take, because they will have willingness, ability, and investment monies, just like China has, and that's where the growth is going to be. And work hard as hell on your your congressional people and on your own businesses. Let's avoid institutional failure, and let's avoid stupid policies. And, you know, we couldn't be better positioned for the next 5, 10, 15, 20 years. Lots of things happen, but, boy, we are positioned if we get out of our own way. And I think it couldn't be a better time to be in agriculture and food, as long as we don't lose another. We lose another crop in the middle of the country this year, and I am fearful that that sets back what has looked to me to be a moonshot for this sector.
Bruce, that's a great wrap-up. I really do appreciate you taking the time to visit with us today. I want to thank the Customer Service Council people, the Farm Credit East members out at their home businesses listening in, as well as our guests today. Again, we will review the questions, and if there was something that we missed, we will get back personally to the folks that asked that question. But with that, I'm going to wrap this up today. Want to remind folks that we have a webinar coming up next Monday, March 25th at noon. Encourage Farm Credit East members to attend that or participate in that and hear directly from the director candidates that are running for the Farm Credit East Board of Directors. So it's a webinar with the 4 candidates that the nominating committee has put forward. And you can hear from them directly, be able to text chat some questions into them as well. With that, I do want to also encourage anybody on the call, if you have not completed and done our Pulse of Agriculture survey, and you can find that on farmcrediteast.com. The Pulse of Agriculture survey, we would strongly encourage you to do that. You have until the end of this week. We're going to do a drawing for folks that have participated in that. 2 iPads were given away. That's going to be done on March 22nd. So I strongly encourage you. That gives us some idea of you know, intentions for the coming year, challenges for the coming year, what farm businesses think is most important. We get a lot of those kind of questions from policymakers, and we think this survey is going to be a real good tool. So we'd encourage you to take a look at that. Again, if you haven't done it, go to farmcrediteast.com and please do that. With that, I want to thank everybody for participating today. We're always interested in suggestions for webinars. And again, please participate next Monday, 12 noon webinar with the director candidates for Farm Credit East.